Since the turn of the year, the issue of Brazil's interest rates has been a recurring fighting call for the government. Almost on a weekly basis, President Lula and many in his entourage have bashed the central bank for adopting a hawkish approach.
Porque ele mantém essas taxas de juros de 3,75 num país que está com inflação anual de 5%.
Nós podíamos sinalizar um corte da taxa Selic, que é a mais alta do mundo.
Se a preocupação é fiscal, com a dívida, não há nada pior do ponto de vista fiscal do que isso.
Jacking up interest rates between March 2021 and August 2022 from an all-time low of 2% to a 5-year high of 13.75%, where they have stood for the past 10 months. But despite the constant bashing, the central bank has stood its ground, issuing hawkish statement after hawkish statement, citing unanchored inflation expectations, and saying time and again that it would not hesitate to hike interests once again if necessary. But a pivot may be finally on the horizon. My name is Gustavo Ribeiro, editor-in-chief of the Brazilian Report. This is Explaining Brazil. We recently got the chance to meet some of our readers in the US and understand how helpful our work is for business leaders, diplomats, consultants. Has Explaining Brazil also helped you understand important issues unfolding in Brazil? If yes, you should definitely consider supporting us by subscribing to the Brazilian Report, the journalistic engine behind this podcast. What you listen to in this podcast every week is just a small sample of what we have to offer in terms of content. We are an independent outlet financed by our subscribers, and if you want us to be able to remain independent and keep producing award-winning journalism, subscribe to our content on Brazilian.report/subscribe. If you are already a subscriber, then you can go the extra mile and sign up to our Buy Me a Coffee fan page. In return, you will get exclusive perks like special newsletters and behind-the-scenes content, as well as a shout-out here on our podcast. And today I want to thank our Buy Me a Coffee members, Tom Nolan, Marta Martins, Pen Ludwig, Leslie Seal, Caroline Hubert, Mark Hillary, John Thomas III, Luis Hans, Erwan Menes, Orlando Black, Steve Knapp, Aaron Berger, James Coney, Kars Vresvik, Alasdair Townsend, Peter Abrahamson, Jim Aofadeju, Michael Fryer, Miller Renascido, David Dixon, José Jose Stankovic, Emerging Market Muser, Yarden Iftar, Tonica Thompson, Anderson da Silva, Kat Kramer, Peter Suffering, Anna Lund, and someone who chose to remain anonymous. If you too believe in the importance of independent journalism, and if you want to hear your name on our podcast, head over to buymeacoffee.com/Brazilian Report and subscribe to one of the membership tiers. Click on buymeacoffee.com/Brazilian Report to find out more. On June 21st, the central bank once again kept interest rates unchanged at 13.75%. In a statement to the markets, the bank did not allude to a possible change of course in its hawkish monetary policy, as many economists had anticipated. But less than a week later, the bank issued the minutes of its policy meeting, which adopted a much softer tone. The minutes show that the Monetary Policy Committee is divided on how it should send signals on future moves, with a majority of members siding with the understanding that economic conditions, quote, might allow the necessary confidence to be built up to begin a parsimonious process of inflection at the next meeting in August. Mário Sérgio Lima, senior Brazil analyst at Medley Global Advisors, Welcome back to the show. How did you read the central bank's words? It was a sort of Jekyll and Hyde moment regarding the same policy decision from last week.
I think at some point you have to look at this almost like there is some schizophrenia brewing in the way they are communicating. They used in the post-meeting statement words such as patience, perseverance, caution, which usually tend to indicate that they are not a move, not either a hike or a cut. In this case, of course, a cut is not imminent, meaning it's not for the next meeting, but we're still assessing it, but it's not going to be at the next meeting. And 1 week later, when the minutes are known, when we know the full extent of the discussion, we basically see that, okay, no, they are already contemplating a cut, maybe for the next meeting in August, but they really need to have some economic data moving to their side to actually start easing. So I think if they had this discussion, and they had, of course, I think this should be assessed in a way clearer in the post-meeting statement, even if it's just to mention that we contemplated it. The way they are putting it, it's like you mentioned, it's like, oh, maybe it seems like there's the monster that's writing the post-meeting statement, and then the doctor is writing the minutes. So when both of those documents are pretty much written at the same time. So I think it's not good to have this kind of almost asymmetrical type of statement. If they want to keep their options open, they could easily have said that we are still not anticipating the rate change unless we see some positive developments. I think that would have covered all the bases. They didn't need to go use all of this kind of caution and perseverance, and then say, oh, but there's a majority that say we may start easing slightly, which basically is like a 25 basis point cut, if situation allows. So I think it's at some point they need to have a more they should keep their options open, but have both documents assessing the same language and not something that we had today.
Mario, the government has relentlessly bashed the interest rates. Do you think this pivot in communication may have been affected by the political atmosphere in any way? Because, the markets found last week's statements very, very hawkish.
Yeah, I think the government, the way the government has really turned very political this discussion, which are technical in nature. Of course, there's no apolitical decision by any means, but that doesn't mean that those decisions aren't technical. They are pretty much. That's pretty much how the central bank takes its monetary policy. But the way that this discussion was being polluted by politics, I think the central bank is also using the communication almost as a political defense in which they shouldn't. One nugget from today's minutes. They were pretty positive on how they are looking at the fiscal framework and how it's moving and how they expect it to be approved. So they were pretty positive. They mentioned that it has substantially reduced risks. I had a meeting with a central bank board member before the meeting. They are allowed to meet people from the market up until 1 week before the meeting, and after the minutes are published, so it's everything regular. I'm pointing this not for myself, but for their sake. They do not disclose any kind of information that should be advantage to anybody. But in that discussion, it seemed to me that clear that they had already seen the tail risks effects of the fiscal policy being reduced by the fiscal framework. So they are saying this, but then they use a lot of like like they bite and then they kiss afterwards, like say, okay, but you shouldn't change the inflation target because that will allow inflation expectations to convert faster to target. So I mean, you see, like they are using this to send signals to government and say, hey, please do not change this. This will help us a lot. When the discussion was brought in February, it hurt a lot our plan. So please do not rock the boat when the Monetary Council meets this Thursday to set the inflation target for confirm these years and set for the next couple of years. So I think all in all, it's not like the central bank is, even if they are doing a technical decision, they are trying to do the technical but with a political undertone, which I don't think it's the most appropriate.
In 2021, the central bank was given operational autonomy to pursue the inflation target, and its board of governors started being named for 4-year terms that do not coincide with presidential terms. And at the time, that was seen as a way of shielding the monetary policy from political interference. But I mean, it appears that it further politicized the issue of interest rates now that we have a conservative central banker and a left-leaning government. The Monetary Policy Committee's minutes try to warn the government against changing the inflation targets, which are currently set at 3.25% with a 1.5-point tolerance band. Members of the government have said that if the target were higher, the need for monetary tightening would reduce, but the central bank's chairman, Roberto Campos Neto, has said on multiple occasions that playing with the target could erode Brazil's credibility and have the opposite effect. How do you see this issue?
I think all in all, I agree with Roberto Campos Neto take, and I think the markets have spoken also into that direction. It basically, when they decided to say, hey, we're going to increase the inflation, Lula was saying in February, maybe the inflation target should be higher because this would mean you would need less monetary tightening to actually meet the target. So like an easier target to reach, if you may. But the way that it was presented, all of a sudden you could see markets' expectations, inflation expectations, were repricing upwards. So it's not like the market was saying, okay, the new inflation target will be 4 instead of 3. So by all means, we believe that the inflation will be 4. Then people were starting saying, hey, this is a government that's not committed to actually delivering inflation in target. So actually doing their own push on fiscal policy to aid monetary policy. So then 4 became not the ceiling, but the bottom of all of the market expectations. And one thing that is important about market expectations, it's not that they just help guide monetary policy, monetary response, but also when you have people in markets believing that the inflation is going to be higher, that would mean that banks, when they're loaning, they also expect inflation to be higher, so they will be putting some premium in their loans, so the loans are more expensive, even if the key benchmark rate remains the same. People at markets, not the financial markets, but the supermarket, will be increasing their prices because they are believing that their costs are going to increase by a higher percentage level, a higher level than what the market they previously expected. So all in all, you actually makes it hard for the inflation to actually converge to the target. So presenting a higher target, even if and there, this is something that you can discuss, whether Brazil, a country that has suffered with hyperinflation for decades until we had the Plano Real, the real as the new currency, we had suffered a lot from hyperinflation. So even if you consider this, you could say, hey, maybe Brazil's economy is not prepared to have a 3% inflation target, which is something that other emerging markets have, other emerging nations have, like Chile, Colombia. Maybe Brazil should have a higher target, like a 4%. I don't know.
And I was going to ask you exactly that. Do you think this inflation target is too ambitious for a country like Brazil? Or, I mean, should the government just leave it be?
Well, I think that's a great question, and one that I'm still on the fence, because I do think, I mean, I have a feeling that Brazil has a lot of Brazil's economy has a lot of indexation, which makes it hard for Brazil to actually get down to a level like 3%, in a way that you do not hurt activity too much. So while I do believe that a 4% is not really that far-fetched, it is important to also understand that, I mean, there are some studies even from FGV University which mention that around 4% of inflation level is when it really weighs a lot on people's welfare feeling. So by all means, if you can get an inflation lower than that, you should be aiming at getting an inflation lower than that. And also, like Brazil never had an inflation of 3% unless you had like a major recession. We are venturing into uncharted territory. When we're venturing into uncharted territory, it's very, very maybe some perceptions. Like I said, a 4% wouldn't be that bad. Maybe we are selling it short. Maybe we can go to 3% if we actually have monetary and fiscal policy moving in line with that. So that's why I'm on the fence, because I can see pretty good arguments on both sides. But more than 4%, I think it's an exaggeration. But 4% and 3%, I think there are some good arguments to each of the propositions, but the discussion should be eminently technical and not politically driven.
Now, another solution for the monetary policy quagmire the government has come up with is possibly trying to lift the central bank's autonomy. Do you think there is any momentum for that in a conservative Congress? I mean, how is the government handling this issue, in your opinion?
I mean, I am ideologically in favor of an independent central bank. I think there is a lot of gain into removing removing one cycle, the political cycle, from the mandates of the central bank board members. I think this allows them more independence in really looking at what their policy, their mandate is, which is basically putting inflation into target. There are some subsidiary mandates like financial sustainability and also the sustainability of the financial system, and also like ease the impact over economic activity. So, I mean, but those are subsidiary. They really need to put inflation into target. That's their mandate. And I think there is institutional gain in doing so. Most countries have this system. But when the government put that discussion, I think it was really abrupt. I can understand why they feel suspicious about Roberto Campos. This is not a personal opinion of mine, but I can see why they would be suspicious of Roberto Campos, mostly because Campos gave them reasons to be suspicious. He went voting in the elections using the Brazilian national team kit, which at that time was almost like a uniform of a Bolsonaro supporter, which, he shouldn't do. He was way too close to comfort from the previous administration. He was photographed in barbecues in the House of Ministers. So, he did a lot of reasons people to be suspicious of him. But in the way that the government presented the discussion became almost like an attack over the institutional and not over the person, Roberto Campos, but the institution Central Bank. So that was a misguided attempt, I believe. I don't think now the Congress will lift the independence because they passed this a couple of years ago, so they do not want to roll back on that. But I do know that what politicians are perceiving as a stubborn take from the central bank in easing monetary policy, yes, in that sense, maybe if the discussion was brought today, I wouldn't be completely sure that the independence couldn't be overturned, because if they really continue to push monetary easing forward, this will create a very negative environment for businesses, and business lobbies will also be going to Congress to demand some change. So this may be, even if the decisions are technical in nature, this can be brought against them, and maybe because then it would not just be the left-wing government saying so. It will be a push from a good chunk of society. So that could actually put the central bank again into discussion, and maybe yielding a different result than when Lula was mentioning this possibility earlier this year.
Have you read our major story on how the semiconductor crisis became a real threat to Brazilian democracy? You can read it on our website, Brazilian.reports. And a good piece of news for whoever is not yet a subscriber is that we have lifted the paywall. Former diplomats from Brazil and the US, as well as the former head of Brazil's electoral agency, contributed to making the story possible. Now, if you want to know how we did that story, the challenges we faced, and how we pieced together every bit of that puzzle, there's a video available for members of Buy Me a Coffee, our fan page program, to be released this Friday. Now here's an extract in avant-première.
So how did you discover this information? How did the story start? How did it come about?
So in May, I was in Washington, D.C. with Laura Kihan, our CEO, and we were visiting clients, we were visiting sources, and in one of these many conversations and meetings that we had, someone actually tipped us with this story by saying that there had been a major diplomatic effort to get the semiconductors that the electronic machines would need, and nobody knew about it.
Yeah, and I remember that I thought it was very odd that I never heard about this story before, because we here in Brazilian Report and the whole Brazilian press covered the elections, the 2022 elections, a lot, exhaustively.
And so what kind of impact has it had? What does this mean for Brazil's democracy and politics in the current moment?
Pretty entertaining, right? There will be more on Buy Me a Coffee, so you should consider subscribing to our fan page. Go to buymeacoffee.com/Brazilian Report. I'm back with Mário Sérgio Lima, Senior Brazil Analyst for Medley Global Advisors. Mário, hiking interest rates is a bitter pill that is used by central banks all over the world to cool off the economy and control inflation. But I mean, it is called a bitter pill because it has very nasty side effects. In the case of an economy like Brazil's, what would those side effects be? I mean, what place does credit have in our economy?
I mean, credit is fundamental for businesses, especially not only new credit. I mean, so new loans become more expensive, but also if you increase, let's just say it's a bitter pill, but let's just say you are on the dosage. So you're giving out way more interest rates than the economy really needed to actually cool down. Because basically what you want is cool down demand. Cooling down demand, you actually make inflation become lower. That's the reason why you increase rates. But let's just say you increased it too much, more than you needed, or you're just keeping it higher for longer than you needed. You first of all, business will break up. We'll see a lot of bankruptcies. You'll see a lot of people not paying their loans. So you have delinquency rates increasing, and also since if businesses are suffering, you may see a higher unemployment than what would be an equilibrium type of unemployment. So you can have a lot of nasty effects, and if people want to, the demand for more expensive but important goods, like for instance cars and housing, it really becomes unattainable for a lot of people. So, and also, just like inflation has this negative effect, higher rates can also have a negative effect into making it. I would say not directly, but helping increase inequality, because more affluent people can protect their investments in inflation linked or the benchmark rate and other prefixed bonds, so they can like have some liquidity and they can also protect their wealth, while the poorer people have nowhere to run to. So you have a lot of also social negative effects. So it is a bitter pill, but it needs to be taken in the right dosage.
Now, when we had low interest rates, many companies took on post-fixed loans tied to the local interbank deposit rate, which is known in Brazil as the CDI. With the benchmark rate remaining high for longer than previously expected, the interest on this debt will also be higher than originally provisioned for. How much of a risk do you think companies are facing?
I mean, I have I have no doubt that a lot of companies will need to seek bankruptcy protection in the near future. And this is not being a catastrophist. This is something that it just goes with the territory. So you have an economic activity that is lagging. It's doing way better than expected. You have to consider this. But also a lot of the goods, the things that are doing well in the economy in the first quarter and probably in the second quarter, for instance, is agriculture output. So, I mean, that's really not going to help the economy as a whole. You see, so the economy as a whole is suffering, is lagging, and you have like lagging demand, and people having to pay way more than they expected for the loans that they took back some years ago. So, I mean, what's the major risk? Let's just say a lot of companies either going bankrupt or not paying what they owe to banks. This could create banks. This creates a situation where banks need to provision even more for the delinquency rates increasing, which means less money for new loans. So I mean, like this is a negative cycle for the economy, in which at some point, you may face recession. So that's why. But you cannot put the full blame on monetary policy. There are some things that Brazil's economy is affected, of course, by global economy. There are some risks in the horizon. Maybe China won't grow as much as expected. Maybe the U.S. will need to face recession to actually bring inflation down. So there are lots of challenges. So the higher rates are just part of the full balance of her risks, if you may, to the activity.
Now, you mentioned that raising rates more than necessary or keeping them high for longer than necessary can be highly detrimental to the economy. Brazil entered a process of monetary tightening earlier than most countries and could exit it earlier than most countries as well. I mean, we have the European Central Bank recently hiking rates, the Fed signaling further bumps could come. Is now the perfect timing for the Brazilian Central Bank to roll back on monetary tightening?
I do. I think first, the Fed is indicating that they skipped one meeting and they will remain increasing, but there's a non-negligible chance, for instance, that they keep skipping. Just like, okay, we're having the possibility of hiking could do well enough into holding inflation down. And they do not need to hike, for instance. So if that happens, will also create a window of opportunity for Brazil. If I were there, I would probably vote for a cut in August. When I have my outlook of a September start, is basically because when I read the minds of the 9 people there, I still feel like there's a majority that wants to wait a little longer, with the trade-off that if they hold for a little longer, because let's be honest, a 25 basis point cut in August won't do anything for the activity in the short term or even the medium. So it's basically just a sign that it's going down. But if they hold by September, I think they can start with a stronger cut of 50 basis points. And my outlook is 150 basis points of cuts from now until the end of the year. And I'm also outside of the consensus for the end of next year. I think that rates will go down to 9% next year, while the medium market is 9.5%, because I do believe that they will be cutting more and faster than markets is expecting right now, because they will be allowed to do so. Inflation will be subdued, and activity will be way too slow, and will allow them to move faster. But they could start. They could start in August, and it wouldn't be absurd by any means.
Now, Robin Brooks, who is the chief economist at the Institute of International Finance, a global association of the financial industry, he says criticism of Brazil's central bank is uncalled for, and said that policy credibility is easy to lose and hard to regain, adding that the Brazilian central bank deserves praise for hiking rates early and being cautious now. On the opposite side, we have, for instance, André Perfeito. He's a Brazilian economist who we seek for comment from time to time. Now, he has a very different assessment. He said that the central bank cut rates way more than it should have a few years ago. Then it raised them more than it should have. I mean, since your predictions are not in line with consensus, as you said, should I assume you're more aligned with André Perfeito rather than Robin Brooks?
No, yeah. I think there is the. I would disagree with Robin in the sense that they have been doing a perfect job. I don't think so. I think by cutting to 2%, it was they were gambling on a situation which didn't happen. Like they were expecting a downturn of the economy that didn't happen. And I don't think it was a mistake getting to 2%. In hindsight, it was, but they are not taking decisions in hindsight. They have to take at the moment. The big mistake, which even at that time you could have seen, they started to hike. They held for 2% for longer than they needed, and I think worrying signs were already showing, especially in some wholesale inflation data, that they were coming way higher than the CPI. So I think that was a cautionary tale that they should have hiked it earlier. But the thing is that when they started hiking, there was this. The people were considering that they had they were wrong going to holding it for so long. So I think that it at some point, they really need to pick up pace faster and more than anyone else, because they also had the price of credibility to pay. So at some point, yes, I think they had to hike too much because their credibility was in stake. And one thing that I don't think I am an outlier anymore, but I was for some while. I think I was a very hard critic of Paulo Guedes' fiscal administration. I always thought that they were completely wrong into what they were doing, especially when they decided to just take the spending ceiling cap as a cap that you actually put on your head. It was like they just completely made a mockery out of it. At that time, I think the central bank was saying that things were going down, going south. And I think most people did not want it, either because of ideology, most people in the market, either because of ideology or because Paulo Guedes was like a good, he's a good seller of dreams, I think most people weren't seeing how the situation was worsening. And that's why I think the central bank really needed to go even higher, because not only their own credibility was at stake, but they needed to pay for the lack of credibility of the fiscal policy, especially looking at when you look at a more broader comparatively, you could see that Brazil's fiscal policy, that some people were praising in Brazil's market, in Faria Lima, but especially the foreign investors were seeing it like the emperor was naked all along, and the central bank needed to pay for the fiscal policy lack of credibility. So I think in that sense, I'm also disagreeing somewhat with André Perfeito, because I think they had to hike it more than needed by looking at just inflation, but they had to pay for other people's lack of credibility. So I think all in all, they had to go to where they went. Now, I can also agree with the fact that they will be cutting faster, because inflation will be subdued by the time they do so.
Mário Sérgio Lima is a senior Brazil analyst at Medley Global Advisors. He's also a columnist for the Brazilian Report. And if you like explaining Brazil, please give us a 5-star rating wherever you get your podcasts. It takes only a second, and it will help us reach a broader audience. Or better yet, sign up for the Brazilian Report, the journalistic engine behind this podcast. We have a subscription-based business model, and your memberships fuel our journalism and keep us going and growing. Thanks to our subscribers, we have been able to cover Brazil and Latin America at length, and for our work, we have won and been shortlisted for multiple international awards. More recently, our newsletters won the Best Newsletter Prize in the Americas from the World Association of Newspapers and News Publishers for a small or local newsroom. In order to keep doing that work, we really need your support. Go to Brazilian.report/subscribe. I'm Gustavo Ribeiro. Thanks for listening. Explaining Brazil will be back next week.